In the last lecture, we examined how, for any given point in time, there's variation in interest rates that apply to different times to maturity. We saw that some variation has to do with expectations that interest rates would change over time. In addition, I argued that some of the variation was due to something called term premium. This premium were based on the notion that long-term bonds are riskier than short-term bonds. You may have noticed, however, that we didn't really investigate why or how longer-term bonds are riskier. We'll do that in this lecture. Specifically, we'll examine two specific things that might happen that increase in likelihood over longer intervals of time. One is defaults, and two is actual rather than expected changes in interest rates. The first creates default risk, while the second creates interest rate risk. In this lecture, we'll examine the nature of both types of risks via a series of examples. In the next lecture, we'll develop a set of metrics that allow us to quantify interest rate risk in particular. There are very many quantitative methods for measuring default risk too. Unfortunately, most of those are beyond the scope of this course. My hope is that the material on defaults in this lecture will give you a good intuitive idea of how to think about the effects of possible defaults. We'll start by considering interest rate risk, and then, in the second half, consider credit risk. Let's start examining interest rate risk by thinking about a specific problem that you might face. We will start simply and then add more complexity. By the way, many of the magnitudes or the changes in these examples that are to follow are not meant to be realistic. They are extreme so that you can clearly see the effect of the changes. So to start, let's consider the following situation. You have a 2-year investment horizon and have just purchased a zero-coupon bond that matures in 2 years. Let's say that the yield on that bond is 4%. That is, the yield curve is flat at 4% at all maturities. Thus, per $1,000 in face value, you will have paid, $1,000 discounted back twice at 4 years, which equals $924.55. With this zero-coupon bond, you don't get any intervening coupons. If you hold it to maturity, then you get the yield to maturity, or 4%, for each year. That is, you paid $924.55, and you get, $924.55 times 1.04 squared. That ends up equaling 1,000 after 2 years. Note that in this case, even if interest rates fell to zero or they skyrocketed, you would still get a 4% annual growth on your initial investment of $924.55. Now consider if you had purchased a 2-year bond that pays 5% annual coupons. If the yield to maturity is the same at all maturities at 4%, that is, the yield curve is flat at 4%, then per $1,000 in face value, you would pay, 50 discounted back once at 4%, plus $1,050 discounted back at 4% for 2 years. That ends up equaling $1,018.86. Importantly, if the yield curve stays flat at 4% from now until maturity, and you hold it till maturity, then you will also get 4% on your money, as with the 2-year zero. To see this, realize that after 1 year, you'll get $50. At that time, if the yields have not changed, then you'll be able to invest that $50 at 4% for another year. That is, the $50 at t equals 1 will grow to 50 times 1.04, or $52 at t equals 2. Thus, at t equals 2, you'll have $52 plus $1,050 from the face value plus the last coupon for a total of, $1,102. So you gave up $1,018.86 at t equals 0, and you received $1,102 at t equals 2. That would be equivalent to investing at a rate R such that $1,018.86 times 1 plus that rate squared is equal to $1,102. That implies R is equal to 1,102 divided by the 1,018.86. All that taken to the square root minus 1, that equals 4%. In other words, your return would have been 4% over those 2 years, too. Now, what would your return be if the yield curve had shifted, say, down to 2% after a year? That is, it was flat at 4 and it shifted down to 2. Then you still will have paid, what, $1,018.86, but you would have received after 2 years only what? $1,050 for the face value in the last coupon, but your $50 that you got at year 1 will have grown only to what? $51 because of the 2% return. This is then equivalent to receiving a return of 1,001 divided by 1,018.86. Take that to the square root, minus 1. That equals only 0.0395 or 3.95%, not 4%. It's less. So even though the yield to maturity when you purchased the bond was 4% and you held it to maturity, you didn't receive 4%. You received less. That's because the yield when you reinvested the coupon had changed from the original yield to maturity. Of course, no such problem exists with a zero coupon bond because there's no coupons to reinvest. With coupon bonds, you face what is called reinvestment risk. Reinvestment risk occurs when your investments have some cash flows that occur at a shorter horizon than your investment horizon. For example, at t equals 1 for the coupon in the last example, whereas our horizon was t equals 2. Okay, reinvestment risk is one of two kinds of interest rate risk. The other kind is price risk. Price risk refers to the change in the value of a bond as the result of a change in yields. This occurs when you invest in securities that are longer term than your investment horizon. Depending upon a bond's time to maturity relative to your investment horizon, bonds that pay coupons will have both reinvestment risk as well as price risk. To see price risk as clearly as possible, let's consider an example in which there is no reinvestment risk. These examples will have to consider zero coupon bonds only. Let's say that the current yield curve is flat at 2% for all maturities. Let's say that you want to invest for 5 years and are considering the following 3 strategies. 1, buy a 5-year zero. 2, buy a 10-year zero and then sell it at the end of 5 years. And then 3, buy a 15-year zero and sell it at the end of 5 years. The returns on the last 2 investments are uncertain because the prices of the current 10 and 15-year zeros 5 years from now, when they are then 5 and 10-year zeros, they're unknown now. If you invest $1 million in the 5-year zero, you will get 2%, since that is the yield to maturity, and you will hold it until maturity. What will you get if you invest $1 million in the 10-year zero, but sell it after 5 years? The holding period yield, or HPY for short, is defined as the yield that when applied to the realized cash flows makes your investment a zero NPV investment. That is, the holding period yield is the internal rate of return you realize on your investment in that bond. Notice that the holding period yield can only be calculated ex post once you know what you sold the bond for at the end of your holding period. Given the cash flows you actually received, when you discount at that holding period yield, the result is the price that you paid for that security. That's what defines the holding period yield. For example, let's figure out what your holding period yield would be if you invested $1 million in a 10-year zero and sold it after 5 years when it's a 5-year zero. All right, the answer depends upon what happens to the yield curve over time. For reference, let's see if the holding period yield, what the holding period yield will be if the yield curve stays flat at 2%. So at t equals 5, let the yield curve be flat at 2%. If so, then per $1,000 in face value, you will be able to sell it for what? 1,000 divided by 1.02 raised to the fifth, or $905.73. Since the original 10-year zero is now a 5-year zero, you discount it back at 2% for 5 years. Since you paid $820.35 per $1,000 in face value originally, your holding period yield is such that $820.35 is equal to $905.73 divided by 1 plus the holding period yield raised to the fifth power. The fifth power because you held it for 5 years. The answer to this question is 0.02 or 2%. So if the yields don't change, then the holding period yield for the longer term bond will be the same as your original yield to maturity. Similarly, if the yield curve stays flat at 2% and you invest in the 15-year zero, your holding period yield over the 5 years will also be 2%. Thus, the maturity of the bond has no influence on your holding period yield, provided that yields don't change. But yields do change. In that case, there's going to be a difference in the holding period yield between these three different strategies. Clearly, the holding period yield for the 5-year bond over 5 years is simply the original yield to maturity of 2%. Thus, if your horizon is 5 years, then the 5-year zero locks in that yield. Giving shifting yield curves, there will be a difference between the 10 and the 15-year bonds. So let's see. What is your holding period yield if the yield curve shifts up to 4% in the next 5 years? When you sell $1,000 in face value for the 10-year zero 5 years later, it's going to be worth what? $1,000 discounted back at 4% for 5 years. That's $821.93. Since you paid $820.35 per $1,000 initially, your holding period yield is going to be $820.35 equals to $821.93 divided by 1 plus the holding period yield raised to the 5th. And this implies that the holding period yield is actually 0.000385, which is much less than what? The 2%. So you're going to get less if you invested than if you had invested in the 5-year zero. And when you sell the $1,000 face value original 15-year zero 5 years later, when it's then a 10-year zero, it's going to be worth what? $675.56. In that case, your holding period yield is actually going to be negative 0.01885. That's a loss of about 1.885%. You can work out for yourself the holding period yields if the yield curve shifts down to, say, 1%. In that case, the holding period yield on the original 5-year, again, is 2%. The original 10-year yield is going to be 3.01%, and the original 15-year is going to be 4.03%. Although the 15-year has the higher holding period yield when rates fall, you typically can't get the possibility of that upside unless you also face the possibility of rates rising and the downside that comes with that. If the current yield curve incorporates the market's view of the expected future level of interest rates, as we argued in the previous lecture, then the yield curve shifts are going to be as likely to shift up as shift down. As a result, the holding period yields for longer-term bonds are more variable than those for short-term bonds. Thus, long-term zeros are riskier than shorter-term zeros. So far, we've gone through some examples which illustrate two sources of interest rate risk, reinvestment risk and price risk. Most bonds have both. In the next lecture, we'll develop a summary metric that will allow us to quantify the sum of both types of risk present in a single bond or a portfolio of bonds. This metric is fairly involved, so we're going to have to dedicate a whole lecture to it. Next, let's consider credit risk. Credit risk is the risk that you won't get all your promised payments. Credit rating agencies such as Moody's, Standard & Poor's, Fitch, and AM Best, which specializes in insurance companies, provide ratings in the form of letter grades that specify something about the likelihood of default. You can easily find information online about what these letter grades are supposed to mean. Realize, however, that these ratings can be hard to compare across rating agencies. One reason is that the ratings that they're difficult to compare is because these companies have different methods for evaluating the creditworthiness of a company. Another reason comparisons are difficult is because they use different letter schemes. For example, Moody's uses BAA, but S&P uses 3 capital B's, BBB, for a similar category. You just need to spend some time on the internet to see the differences. In this part of the lecture, I want to spend time focused on the numbers, not the letters. In this section of the lecture, we will examine the kind of information that is used to measure or summarize the risks associated with default events. We'll examine 2 important parts, information on 1, default probabilities, and 2, recovery rates. Both will be necessary to be able to price a bond with default risk. We will also examine a technique for inferring the likelihood of default from market prices. This method is fairly crude, but it does allow you to use the prices of other default-prone bonds to see if the price of an alternative bond is fair or not. That is, it allows you to get a sense if the bonds are priced fairly relative to one another. If they are not, then this suggests a potential trading strategy. Aggregate data on default experience of a collection of bonds by original credit rating is available for Standard & Poor's and also in academic papers. For example, Edward Altman, a professor from NYU, is one of the foremost authorities on default, and he has a lot of information on his own personal website. The typical information that a credit rating agency has to summarize credit risk is contained in a matrix of cumulative average default rates based upon historical data. Such a matrix shows the probability of a company defaulting on a security they issued within a number of years as a function of that issue's credit rating. A typical matrix is structured as follows. Across the top, there are different horizons measured in number of years. The first column is for within 1 year. The second column is for within 2 years. This extends all the way up to within 10 years. Down the side is the credit rating, the best rating at the top falling to the worst rating at the bottom. The numbers in the matrix answer the following question. For a bond originally issued at rating X, what is the probability that it will default within Y years? For concreteness, let's think about the row associated with the BAA rated bonds. The entry under 1 year column specifies the probability that a bond rated BAA, when issued, will default within a year after it was issued. Let's say that probability is 0.2%. That's only 2 out of 1,000 such issues really defaulted within a year. The next entry over to the right specifies the probability that an original BAA issue will default within 2 years after its issue. For example, let's let this probability be 0.6% or 6 out of 1,000. Note that the entry is for within 2 years. Thus, the category includes issues that defaulted within 1 year and those that default within the second year. Since we know that the likelihood is going to be 2 out of 1,000 that there's a default within the first year, then the entry in the second year column indicates that there's only going to be 4 additional issues that default in the second year for a cumulative number of defaults of 6 out of 1,000. By subtracting the entry in the column to the immediate left of a given entry within that given row, then you determine the probability an issue of that rating will default in the year corresponding to that column. This is called the incremental or marginal probability of default for that year for that original rating. The marginal probabilities obtained from a matrix are the answer to the following question. For a bond originally issued at rating X, what is the probability that it will default in year Y of its life? Not before, but in that year. For a given row corresponding to a given rating at issue, the entries in the table increase from left to right. This simply reflects that it's more likely to have more defaults the longer we wait. What may not be obvious is how the marginal probabilities of default change over time given the differences in default ratings. Let's compare BAA firms with CAA firms. What is typical is that a CAA issue is very likely to default within a year. Say almost a quarter of the CAA firms default within a year. The incremental probability of defaulting in the second year will be something like 13%. For CAA, the typical likelihood of default in the third year will be less than the incremental default for the second year, say at 10%, not 13%. Continuing down the row, the incremental probabilities typically continue to fall. Next, consider the row for the BAA firms. For BAA firms, the incremental probabilities typically grow as you move from 1 year to 10 years. That is, the difference between each adjacent entry gets bigger as you move to the right. Thus, the pattern of incremental probabilities for the higher rated issues is the opposite of that for the lower rated issues. So why? It's actually intuitive. An issue that is originally rated at CAA is very likely to default very early on. And given that it doesn't default early on, it's less likely to default later on. The higher rated BAA issues are less likely to default early on. They're highly rated for a reason, right? And then given these bonds don't default early on, it will take more time for the defaults to actually occur. Note that these probabilities are all from the perspective of when the bond was issued. That is, they are unconditional probabilities in the sense that the probabilities are based solely on the kind of information someone would have at the time of the issue. That is, these probabilities are not based on knowing anything about the realized experience, i.e., whether they survived the first year or not. But you might be interested in investing in a bond that's been around for a while. Thus, you might want the answer to the following question. What is the probability that it will default given that it has survived so far? This is a conditional probability. Although the probabilities in the cumulative default probability matrix are unconditional probabilities, they can be used to calculate conditional probabilities. Specifically, you can calculate something called a default intensity or a hazard rate. Both are defined as the probability of a default over a particular year of issue conditional on it not having defaulted yet. Again, let's think about the CAA issue. Let's say that you were considering buying a bond that was originally issued as a CAA bond 2 years ago that is not defaulted. For this bond, what is the likelihood that it will default in the next year? The answer to this question is the hazard rate or the default intensity for the third year. To answer this question, realize that the probability that it survives until the beginning of the third year is simply 1 minus the cumulative probability for 2 years. In the CAA case, if the cumulative entry for the 2 years is 40%, then the probability it survives until t equals 3 is 1 minus 0.4 or 0.6 or 60%. And what is the probability that it defaults during the third year? If the entry for 2 years is 40% and the entry for 3 years is 48%, then the probability it defaults in the third year is simply the marginal probability. It's 48% minus 40%, which is equal to 8%. Then, out of the 60% of the times that it gets to year 3, only 8% of those times does it default in the third year. That is, the hazard rate for the third year is 8 divided by 60, or 0.133, or 13.3%. Okay, so now once you have these probabilities, you still need some additional information to help you figure out what is the value of a risky bond. The additional piece of information you need is something called a recovery rate. A default trigger is a potentially long and drawn-out legal process by which many people argue about who gets what. Since the firm's assets are unlikely to be worth nothing, the outcome of this process is that the debt holders will get some fraction of what was promised to them. Because it's very uncertain what this fraction will be, and when the bondholders will get it, it's very hard to come up with an estimate at default of the present value of its final payment. The good news is that there's a good estimate of the value. It's simply the value of the bond once the default occurs. The recovery rate is defined as the fraction of the bond's face value that the bond sells at when the default occurs. Recovery rates vary across bonds according to their seniority. For example, senior secured bonds have priority over junior subordinated bonds. Thus, holders of junior subordinated bonds will only get something if there's anything left over after the senior secured bondholders and other higher priority bondholders get their share. Thus, recovery rates are higher for senior secured bonds than for junior subordinated debt. Senior secured might recover 60%, whereas junior subordinated debt might only recover about 30%. Okay, now that we see the typical kinds of information we have concerning default, let's examine what you can do with this information. For a given recovery rate, you can get an estimate of the market's belief about the likelihood that there will be a default on that bond. If there's a positive risk associated with default for the bond, then that bond will have a yield that is bigger than the yield on a similar risk-free bond. The difference on the yield in the default-prone bond and the risk-free bond is called the credit or default spread. The extra yield from the spread compensates the holder for the greater chance of a default. Let's see to infer the likelihood of a default from the spread. Let's just start by assuming that we are in a risk-neutral world. For a given probability of default, let's say denoted P, and a given recovery rate R, it must be the case that the spread, denoted S, is such that S is equal to P times 1 minus the recovery rate. That is, per dollar invested, you lose 1 minus R if the default occurs. For example, if the recovery rate is 60%, you're going to lose 40% in value. The extra return per dollar invested, which is the spread S, must equal your expected loss. Your expected loss is simply the probability of default times the loss when you're in default, plus the probability of no default times no default. So it's just P times 1 minus R. So, how do you get the spread? You essentially have to reverse engineer using a zero yield curve in order to get the spread under the risk-neutral pricing. Let's do an example of this. Let's say you have a 4% coupon bond that pays coupons semi-annually with the next coupon in exactly 6 months. This bond was a 5-year bond that was issued initially 2 years ago, so now it's a 3-year bond. Thus, the cash flows on the bond going forward are per $100 in face value, $2 after 6 months, $2 after another 6 months, on up to $102 after 3 years. Let's say that the bond is currently selling at $96 per $100 in face value. The first question is, does the market think that there's any default risk? To see if it does, let's see what the value of the bond would be if we had risk-free rates that we applied to this bond. To do that, we should just discount the cash flows using the risk-free rates off the zero yield curve. Let's say that when we use those rates off the zero yield curve, the present value of the cash flow is $99.34. Thus, if our 4% coupon bond was really default-free, the price would be $99.34 per $100 in face value, not $96. Thus, the market must think that there is default risk. The yields off the yield curve account for the interest rate risk through the term structure. The difference tells us something about credit risk. To figure out how risky, we need to determine the spread between the yield on the risk-free bond and this risky bond. To get the yield on the risk-free bond, what we need to do is assume a single rate that when applied to the cash flow generates the price we get as the risk-free bond. So we're looking for that single rate, that single yield that's consistent with a price of $99.34. So what we're going to do is we're going to keep changing the rate we have assumed until we get a price that's equal to $99.43. In this case, the final rate that we're going to get is going to be the yield to maturity on a risk-free version of the bond that we're interested in. In this example, the answer is 4.2795%. This is the default-free yield. Next, we need to find the single yield when applied to the 4% coupon bond generates a price of what? $96 per $100 in face value. This is going to be the yield to maturity on a default-prone bond. Again, we apply the same technique we used to get the yield for the equivalent risk-free bond. This time, we need a single yield such that when we apply it to the cash flows, we get a price of not $99.34, but $96. The result then is the risky yield. In this case, it's 5.54%. Thus, the spread is going to be what? 5.54% minus the 4.27%, which gives us a spread of 1.27%. If we assume a recovery rate of 0.6, then the probability of default is going to be equal to this 1.2% divided by 1 minus 0.6. This gives us a value of 0.0315 or 3.15%. So what does this mean? Should we sell? Should we buy? This number allows you to price other bonds with similar risks, and that will help you decide. For example, let's say you find a junior subordinated bond that has similar characteristics, but it has a 3% coupon that matures in 3 years. It's currently priced at $95 per $100 in face value. Is this a good deal? Well, let's see. If it's similar to the bond that we just determined the spread for, then we can discount back the cash flows on this default risk-prone bond and get its value using the spread. If the result is 93.27 per $100 in face value, then the 3% coupon bond is overpriced at $95. So in fact, that's the price you get when you discount it back at the risky default rate. So do not buy it, and if you own it, sell it. In this section of the lecture, we have examined how default or credit risk affects the yields on bonds. While most investors only want to consider highly rated bonds, there's a significant amount of return to be earned by bearing default risk. Once you get an estimate of the default risk premium, or the spread, you have to decide if it's big enough to induce you to invest. Of course, you will want to look at the returns on equally risky bonds to see if the return is even in the ballpark. If the premium doesn't meet what you can get elsewhere, then walk away. But if the premium is comparable, you will need to decide if it's big enough. Given the market price, there's going to be some sense in which the premium must be big enough for the average investor present in the market. If not, the price would be lower. So you just need to figure out if you are more or less willing or more or less able to bear default risk or more or less risk averse than the average investor in the market. If you are less risk averse or more able, then you can make a lot of return on these default prone bonds.